And we're live.
Hello, everybody. Welcome to this week's edition of Vishal and Company. This week, Vishal is going to be talking about the stock market sell-off and the bond markets. Galen is here to cover all things Elon Musk, his favorite man, and corporate responsibility on social media. And lastly, we have special guest here today, Joseph, to speak about NFTs and all things crypto. I'm the resident not finance person to ask questions and keep them in check when they're not making any sense. And that's about it. Vishal, all yours.
Thanks, Maddie. So it's been a wild week, a lot of action. First of all, we saw the return of some of the meme stocks. GameStop was up 103% overnight just a few days ago. Then got sold off, got slapped. We saw the same thing with AMC costs. I believe even BlackBerry as well. But, there was a huge gap here. You can read more about that on my Market Moment article. But the real story is the sell-off of the stock markets. Wild week, even a wild week, a wild day today. But just on Tuesday, we had this major sell-off, and this is the daily chart. So each of these represent a daily candle. So look at that sell-off we had and that big dip. Big bid. Someone step in. Was it retail guys, buying the effing dip, or was it the Fed's plunge protection team? But huge dip, and then it looked like things were about to turn north again, and we were going to make new all-time highs. In fact, the Dow Jones actually did make all-time record highs, so things were looking rosy there. And then yesterday we had this big slap down on all the equity markets, and that was a story. That was the fear. A lot of people were worried about another stock market sell-off and a crash. And as you can see right now on today's daily candle, there is just some indecision here, a battle between the bulls and the bears. But we will take a look at the longer-term charts in just a second. I want to mention why the markets got freaked out about this, and a lot of it has to do with the bond market. I know if TK was here, he would have loved to talk about this, but we always been mentioning that 10-year yield, right? So interest rates on that 10-year yield bond, when the yield is moving up, what it indicates is that money is leaving bonds, right? So people are selling bonds, which causes the interest rates to spike up. And generally in the asset allocation model, we tend to see that money leaving bonds and entering the stock market. But when we do not see that, there is a bit of an issue, right? There's something to be worried about. And as you can see here, I wrote about this on my 2021 outlook about this breakout here on the 10-year yield above 1%, saying, hey, look, folks, there's a chance we're going to see yields hit 1.5%, which is what it did. And what I want to see is I want to see how this week's candle closes. If it closes like this, I think we're good. I think we're in the green, and the markets will recover next week as the yield declines. But if we continue to make a move higher and we see interest rates, bond yields, on the 10-year yield spike, and I mentioned interest rates because the 10-year yield is essentially what is used to determine mortgage rates and loans, etc. in the United States, right? So it is pretty crazy. I've heard some stories about people with some variable mortgages in the States freaking out a little bit. But if we do see that breakout, I think there is some more downside on the markets. But let's just do a blow by blow and talk about why these markets were freaked out. So on Monday, and again, these are all updated, but I'll tell you what was happening. But on Monday, what we saw on April contracts, if I can click on this and it'll show up. But what I have here is actually the Fed futures, right? So if you go to the CME group and you click the Fed Watch tool, what this shows us is what the market and traders are pricing in for future interest rate hikes. So for some reason, okay, there we go. So what we're seeing here is this is where the market, or where we are currently, right? We are at 25 basis points here. And for some reason, heading into June, heading into September, heading into November, we were seeing that the market was actually pricing in an interest rate hike, and it still is. See, there's a 4.1% chance that the Fed hikes rates to, well, just by 25 basis points. And it doesn't seem like much right now, but at the beginning of the week, this number was actually at 10%. It was pretty high, and that's what was freaking the markets out, because I don't think anyone was expecting interest rates to rise this year, because remember, the Fed was telling us, hey, yeah, interest rates aren't going to rise until 2023. But the media and many other analysts have been talking about inflation, right? With all this money printing, if inflation comes, the Fed has to hike interest rates in order to counteract that, right? So, okay, we have that inflation story, but we have all this debt, which means we can't raise interest rates because there'll be issues. So the Fed sort of dug themselves in a hole, and the market was really freaked out about this. But enter our savior here, Jerome Powell. On Tuesday and on Wednesday, the Fed chair was testifying to Congress, and all these questions were obviously, I think there was a bit of a script, because Powell was trying to calm the markets down, ease all the fears, and he did mention, hey, folks, now's not the time to think about budget deficits. We're going to continue to buy assets, and I don't expect inflation to rise to troubling levels. And as you can see, that actually did bring these probabilities of interest rate hikes down to 4%. But the market was really freaked out, right? That's what it was all worried about. And this rise here in the 10-year yield was indicating that people were pricing in a potential hike in interest rates. So this is what everyone's watching right now, this 1.5% on the 10-year yield. And did the market buy Powell's argument that, hey, don't worry, we're not going to hike rates, but will inflationary pressures force the Fed to hike interest rates, right? So this is the whole story, and people are scared or afraid of interest.
And my question is to you, is that most of these people, and I'm hoping everybody can hear me now, my question is to you, is that all these people that have taken advantage of this stonk run on the market, where everything seems to go up, let's just keep buying, right? And so all of the money that they would have at some point put into treasury bonds, mutual funds, whatever, have dumped it into these stocks and equities, right? Now that we've come to a point where we're having to deal with the debts that are being piled up during the pandemic, all of this money that was sort of tucked away so it doesn't actually show inflationary pressure is now going to have to be released into the system in order to pay for groceries and fuel and mortgages and stuff. And we're going to see that rate hike, I think, still. I don't think the market at this point is accurately reflecting the recovery that we are undergoing, because it's V's. It's not a V, right? So anyway, that's me.
Well, I think you raise a good point here too, because what we just saw this week, right, was just a 10% probability of a 25 basis point rate hike, which is very tiny, right? 25 basis point isn't very much, but that in itself was, that freaked the market out so much that we saw a move like this. So it's sort of scary to think about where we are, and we had to have the Fed, come in to tell people, oh yeah, don't worry about this 10% probability of a 25 basis point cut. So I put the argument that I think technically we are now like Japan and Europe, right? Where I don't think interest rates can rise anytime because of all the debt that's out there. And what many people are talking about is what the Fed is going to do next is something called yield curve control. And in layman's term, really what it is they play around and manipulate the bond market. If you understand finance and the markets, this has actually been going on since 2008, right? So it's really now just about the rhetoric, and I think it mixes it. Well, it'll play in really well with what the Fed wants to do, because they've sort of dug themselves in a hole by telling the market and the world that, hey, the economy is improving. So when the economy improves, people are expecting now, okay, we're going to begin to normalize interest rates, but we're still seeing with the jobless claim data, I don't think we've even bottomed yet on the real economy. But what this yield curve control allows the Fed to do is it'll allow them to increase their asset purchasing program, and the rhetoric will be, from the market and from the media, hey, the Fed was saying that the economy was improving. They didn't want to increase their asset purchasing program because, you don't do that when the economy is improving. But because of this yield curve control, now they have a reason to increase their asset purchasing program, right? So it's the typical problem, reaction, solution. And I think that's going to happen, right? We're going to see yield curve control, which basically means, they do it through quantitative easing. The Fed will step in, will buy more bonds, which will, again, cause interest rates to decline. And we've talked about this in the past, right? The Fed is already buying junk bonds and HYG, right? The high yield bonds for corporates. So they'll probably do the same.
Was this at Larry Fisk's suggestion?
Well, they've already been doing this since 2008, right? So it's just a way, like I said, it's this rhetoric, right? The financial media will do its part to just tell people, hey, yield curve control. But people who understand the system know that this has been happening since 2008, right? Like, we know the Fed's already been doing this. So I think the market, it's still going to be moving up because of that yield curve control. They want to see that 10-year yield here start to decline, and we are actually seeing this sell-off here at 1.5%. But just quickly here on the technicals before we talk about the good old crypto market, drawing some trend lines here. So you guys know trend lines, the slope, it shows you what an uptrend is. And generally on a trend line, we want to see 3 touches for it to be a strong trend line. So I'm showing you here on the S&P 500, look at where we actually did touch today. There is a trend line here, which would mean this uptrend is still intact. You can do the same with the Dow, but I want to show you the Nasdaq here, which I did post in one of my charts earlier this week. But the Nasdaq actually did break below a trend line, and maybe you guys can sort of spot what I'm seeing, because we do mention the head and shoulder pattern quite a lot, but it's not the perfect right shoulder here, but it is a shoulder nonetheless. Maybe we still do bounce up before we decline here. But this zone where the Nasdaq is testing today, this 12,680, if we get a close below that zone, this pattern triggers, and it would mean that the bull market on the Nasdaq is officially over. So we'll watch to see what the market does here. But as I said, watch that 10-year yield. If this begins to decline, I think we see the market start to ease away that fear. And again, I think people will realize, okay, the Fed will probably come in to do some yield curve control. And by the way, maybe this is the Fed already, right? Maybe that's them buying bonds right now.
Yes, it's over. It's over.
It's you think it's the Fed, sorry, or
just the Nasdaq? I honest to God,
the Nasdaq.
It's just been too emotional and fiery. It's this little run is over, and it's got to settle somewhere in reality. I mean, I agree, Galen. Like, I think it does, but I just think in this environment, like everyone's going to cash out when the party's over, but I think right now people are expecting, okay. Can you imagine how the markets are going to react at that point? People understand the domino effect. Like when they started to clear out to get their profits, which they started to do this time, and then they got scared the living bejesus out of everybody. But if anybody actually tries to get their money back, the markets are going to pit.
Well, I'll be honest, when I saw this yield, I was actually a bit freaked out, right? I know last week TK was a bit freaked out too, but this was actually really scary level stuff because, when we start to see this move uncontrollably, because the bond market is the largest market in the world. When this begins to rise, right? When we're seeing interest rates start to spike, maybe even to double digits, that's what some people are expecting, right? In the future, that's going to cause a lot of things to basically correct to fair value, right? We're talking stocks, we're talking real estate. I don't think people are going to like that. So right now, I think, people don't mind if the central bank manipulates this kind of stuff because, a lot of people say that they don't like the system, but when interest rates spike, things will become really fair, really fast. And I don't think many people will want that, but that's what we're watching, right? We are sort of in unprecedented times right now with all this monetary policy as well. But watch that 10-year yield, and I do expect that yield curve control, and we'll see, right? I think if the Fed does that, money still has to go somewhere, and they're going to ride the stock market, even though, like I said, right, Wall Street and most investors know that one day the party will end, but if the Fed keeps the party going, just follow along for now.
Oh my God! It's the 50. It's the 50-gallon drum, man. It's the tin can they've kicked down the road for so long. It's turned into a 50-gallon drum of nuclear material that's encased in nitroglycerin. Basically,
It's crazy.
The next kick is going to blow the system up.
I think you're on the point there, man. I think so, but we'll see if that happens soon or if they try to kick the can down the road. But the 10-year yield, that's what will tell us.
Yeah. No, very true. Very true.
All right. I'm gonna pass to Galen. Thoughts on Elon Musk in general?
Okay. Well, all right. I've actually, but I'm torn on this guy because I'm in some ways.
Sounds like a hell of a party.
It is. I'm torn on the guy because I do feel somewhat impressed by his accomplishments, what he's gone through in his life, and what he's been able to overcome, and the thing that he's been able to stick to, and his determination, and his ability to stand up in the face of adversity, and lots of it throughout much of his life. However, the way that he's gaming the system, I think, does not belie somebody that's actually doing a good corporate citizen. I see him using a system that he's grown jaded with and has decided that fuck the establishment, I'm going to run things my own way. And the problem is in doing so, what he's doing is he's manipulating his own stock prices. And on top of that, just recently with the idea of Bitcoin, he boldly stepped into cryptocurrency and just started messing with the prices.
And Dogecoin.
Absolutely. And with just ridiculous stuff, knowing that there's a legion of idiots out there that would in a second buy anything that came out of his mouth. Now, at some point, the board of directors, the SEC, has to look at this type of influence and this ability to make these people's minds up without them even thinking and actually cast that responsibility back on the person that's giving that message. Elon Musk, with the ability to step on Twitter as he does, is now impacting the market more than the market makers themselves. And that in and of itself is something that the SEC should be taking a very serious look at.
How do you moderate something like that, though? Even if it is, like, how do you choose when to sort of like you can't really silence someone's voice and it's the dumb followers who are listening.
Twitter already kicked President Trump off. I'm sure they can do the same with Elon Musk if they wanted to.
That's a good point. You could take the platform away from them. That is one way. And Maddie, you do have a good point. How do you police it? What is personal opinion and what is deemed to be sort of a command from on high? I don't know. Is there a defining factor in where this person stands in society once they reach that kind of corporate echelon or governmental position, that their words are given far more weight than your average Joe that's just going to get on Wall Street bets and say, hey guys, I'm going GameStop, right? Even though that in and of itself has proved it to do the same thing. I just think at this point we really need to consider, because of the idea of all this cheap money and the ability to be at this point, because of Silicon Valley and SPACs and the idea of raising billions of dollars on a dream, there's so much rainmaker capitalism right now, it's dangerous. And I don't think this kind of manipulation is actually good in any way, shape, or form.
Well, my question is, how much
Sorry, what's that?
Apologies.
What's that?
My question is, how much responsibility do public people have towards their public? I mean, it's a question of, this guy has a massive platform. If he gets on there and he says, buy Bitcoin, there's always going to be people who do it. Mm-hmm. Should he necessarily be punished for having an opinion in a public forum as a person with a platform of that size?
Yeah. But okay, let's put it this way then. Good point, Joseph. But then let's say that he makes a $1.6 billion bet on Bitcoin, and then within days goes online and says the price is fucked. Excuse my language. Right? You know what's going to happen then.
course.
right? Buy the dip. That's basically what he was doing.
That's the same thing China does.
So is that supposed to be ethical? Is that something we are to accept? Is this the new way of business? Because it's not really business. All it is playing with finances, right? He's not acting as a car manufacturer. He's not acting as an industry icon. At best, he's a financial manipulator, a hedge fund manager, at best, at this point. And again, I don't want to take away his accomplishments or his intelligence, because that would be disingenuous. But I do believe that he has completely overstepped the bounds of ethics in the way that he, A, raises money and handles his own stock prices.
He's living the American dream, Galen.
Okay, Joseph, let's hear more about crypto.
All right. Well, first and foremost, I think I owe an apology to Vitalik Buturin, the founder and I guess key developer of Ethereum. I said that Ethereum 2.0 was ultimately going to fail, and there's a large part of me that still thinks it's going to fail, but it might be a little too early to make that call. Like what he forecasted in one of my notes last night after our conversation was that over the course of 2 years, he was going to roll out Ethereum 2.0. It wasn't going to happen in December. It wasn't going to happen in February. It was going to happen in 2022. Okay, the timeline looks like this. In 2020, he launched the Beacon Chain, which he introduced the consensus mechanism of staking to Ethereum. In 2021, sometime this year, he's introducing sharding, which I will probably have to get into in a bit. And in 2022, the docking takes place. The mainnet Ethereum docks, emerges with the Beacon Chain, and the entire network basically switches from proof of work to proof of stake because it's kind of a mixed bag right now. You can do both. Okay, now in this case, I said that it was supposed to already happen, and that is actually not the case. Now, excuse me, I need to scroll down to my notes here.
So here's what Joseph was talking about: the Beacon chain, which was live here, the shard chain, and then the docking with the estimates for the docking in 2022, and the shard chains at 2021.
Yes, indeed. Now, okay, so I should probably at the very least, explain how staking works. Now, staking differs from proof of work in that, I'm going to explain how sharding works. And staking is pretty easy to find. Okay, when you normally do proof of work or proof of stake, what it requires is each individual server or computer to have one copy of the entire blockchain in which it verifies. And this is, for proof of work, this is time and energy intensive. For proof of stake, this is, well, it's actually neither of those things, but it can be time intensive and can get rather contentious in terms of competition. Now, for sharding, what this does is it takes up bits and pieces of the entire blockchain and spreads them out over multiple nodes. And it's more of a further decentralization of the decentralized process. Manny just nodded like I just spoke French. So.
No, I'm actually understanding. Just a bit. I am writing an article about NFTs, so I've been researching blockchain. To just clarify, really, really simple. Blockchain, it's literally like if I put in new information, that's the block. And then if, like, let's say it's a piece of artwork and I sell it to someone, there's a chain, and then it shows the new person I sold it to, and it's chronological and linear, correct?
It's decently close enough, yeah. It's actually information that goes on the block with other pieces of information. But that's basically it.
What do you mean?
Okay. The block, when you close the block, it verifies everything that's been put on it before. So your piece of art joins millions of other pieces of art as the block closes.
Okay, I see what you're saying.
Okay. Now, what this does now, okay, all right. Now, proof of work and proof of stake that can take a while. For Bitcoin, it's 10 minutes. For Litecoin, it's 2.5. Various other coins have various other time limits for closing the block. Now, what sharding does is it takes up bits and pieces of the blockchain and spreads them out to multiple different people, each to work on, and then it puts them all back together and with everything verified. Now, it's supposed to speed up the process monumentally. Like Ethereum, like the number attached to Ethereum is I don't know how to say this. It's 15. It's 50 microprocessor. It's 50. I don't know. I'm having a hard time getting the word. It's microtransactions. 15 microtransactions, more or less a minute, and at the tail end of Ethereum 2.0, and this is where I think it's a pie in the sky idea. It's supposed to be over 100,000.
Do you think blockchain's ever going to fucking make it? Oh,
Ethereum 2.0 needs to happen for it to make it, basically.
Yep.
If it doesn't happen, then it'll just be another technology which niche people use, like me.
Yeah. So from my experience and what I've heard is a lot of the crypto guys look at Bitcoin as the safe haven and then Ethereum as the actual currency of the internet or the actual money of the internet. I talked to Joseph just a few days ago and I told him I actually did my first transaction using Ethereum, right? So I've held some, but I've never really transacted with it. And it was quite slow at first, but the big thing was the fees. I was paying, and I think they call it gaslight fees.
Yes.
I was paying 30% of the transaction was the fees. Yep, it's pretty high. But apparently this is a normal thing. This is a normal thing, right? Right,
what's the point?
Well, that's what Ethereum 2.0 is supposed to be fixing, I believe. Right?
It's one of the things that Ethereum 2.0 is supposed to fix. There are a lot of things wrong with Ethereum.
Yeah.
Like personally, if I was using a decentralized computer model, I would have went with Cardano. I actually like Cardano a lot more.
Cardano, okay.
Have you heard about Canadian digital bank VersaBank trying to come out with its own stable coin that's backed by fiat currency, and it's going to try and move that on into the States as well? Do you think
I've heard of
that
QCAD?
Sorry, what's that?
I've heard of QCAD, which is a Canadian stablecoin, which is actually in existence.
Yeah.
I didn't know it was actually.
Yeah, well, they were talking about it. It's a Canadian bank called VersaBank, and that they're trying to adopt that as their currency, and they're backing it with fiat currency. From what I understand, this is all very confusing. And what they're trying to do now is expand their operations into the States and into other countries using those particular fiat currencies as the basis for value for their coin.
That's what I love about this space. There's always new things, always something to learn.
Mm-hmm.
I mean, there isn't a 150 year, 200 year infrastructure, which is all encoded like standard investing. I mean, with this stuff, you learn something new every month. Like I learned about QCAD like 3 weeks ago.
I'm just going to interrupt real quick. We have a question from a YouTube viewer. How are you all hedging against the move up in rates?
How you doing, Vishal? How are you keeping yourself safe?
From the rates, well, the funny thing is, a lot of people wanted to go into gold, but gold does really poorly when interest rates are moving higher, and you can see gold is actually getting smacked here currently right now. So, I mean, honestly, this is just me. I am hedging with my trades. My long-term positions are still pretty much holding, right? So I like to distinguish again between your long-term investments versus what you're trading with, right? So when I think about long-term, I'm looking at companies which I believe 10 years from now are still going to be here. Whatever you think those are, that's really where you do your fundamental analysis. But I personally like a lot of these commodity stuff, Fortis gas, because everyone's always going to be using gas. Maybe some people might argue Netflix and a few other stuff. But I really like the hard asset stuff. And that's really what I'm doing. And, with my trading, I am holding cash. I'm just waiting to see how this plays out. But my belief is the Fed is going to step in to buy bonds to bring interest rates down. and that's going to be another buying opportunity for us here in stocks, and they'll continue to keep this going. So right now it's a be patient right now, but I am expecting that yield curve control. Maybe some people are buying Bitcoin. Let's take a look at the chart. Not really, not yet.
I don't know, man. I'm sticking. In order to try and hedge, because that's the key word for me in this question. In order to hedge against what I feel to be the increase in interest rates and what is going to be happening in the market over the next little while, is to find the value stocks.
Exactly.
Stay the hell out of tech. For instance, I'll say it again. United Rentals, man, they made me like 10 grand since I first bought their stock. It just, it's something that's so integrally involved in construction. I don't even know if I said that right. Anyway, it's
just
vital.
a little quick.
Yes.
Just really quickly, what the market and what people are doing are actually running into the US dollar. So that's the thing that people are actually running into for safety right now. Not gold, but the US dollar.
We are just about up for time. Does anyone have any last words of wisdom to impart?
Joseph, can you quickly tell us about NFTs, man? I heard about Logan Paul making millions of dollars on this.
Well, I don't know. It's you remember back in 2017, all the various things we were saying about blockchain that was going to save the world and all this other junk. I mean, I just see it as another version of high-tech digital tulip mania, to be completely honest.
So it's sort of like
ICO. I don't know specifically what there is to say about them at this point. I mean, we have Mark Cuban, we have Logan Paul, we have various other people out there who seem to be tooting the horn on it. And to be honest, it really isn't anything to be. I mean, don't get me wrong. There's value to it. I mean, the whole idea that you could split up ownership of a house or a car 13 different ways and there's places to make money off of that, but it's not necessarily it's not the revolutionary technology everyone seems to be touting it as.
Okay. So just a mania. That's what you're going with?
I'm saying there's a lot of hype out there, and you should really pay attention to what is being sold and not being said.
Okay.
Yes, lots of mania. There's an artist named Beeple. I don't know if you've heard of this. And have you heard of this?
No, tell me. What? No.
Oh my gosh, it's the first NFT artwork that has been sold, I think, with no physical copy of any sort. Like, it's just the digital file for $6.6 million from Christie's in New York. And this artist, this is actually a really great way to end off. His Instagram bio is, because I've been doing research for this article, art shit for your YER face hole.
Oh.
$6.6 million for this guy's work. So the world is a crazy place. People were comparing him to Picasso. It was just absolutely sickening. On that note, we are out of time, but thank you so much for tuning in, and we will be back next week. Thank you, Joseph, for joining us.
Yes, thanks,
Thank
Joseph.
you.
Bye, everybody. Bye,
everyone. Oh, that 10-year.
Okay.